Hello and welcome to Retirement Today. My name is Jenna Cairns, founder and financial advisor with Beacon Wealth Advisory, and we're here to help get you to and through retirement with financial peace of mind. If you'd like to listen to this podcast or any of our past podcasts, we invite you to go out to Apple Podcasts, Spotify, Amazon Music. We also have a YouTube channel if you want to view it out there. And if you go out to YouTube, type in Beacon Wealth Advisory and hit subscribe, you'll be notified every time we have a new video out. Before we get started, I want to bring on my co-host, Jaclyn Gladhill. Always great to have you on the show, my friend.
Well, thank you, Jenna. And I'm excited about this one. I know that we're starting a new series here, kind of on tax planning in March. So, since everyone's really thinking about taxes right now, and it's kind of the time to do it, right?
Yes, it sure is, right? Everybody's gathering their things together, dropping it off at the CPA, so it's fresh on our mind, right?
Yes, absolutely.
So, yeah, and for anyone that tunes in this month, like she said, every week this month, we're going to do a topic on tax planning. For anyone that calls in and gets a complimentary consultation, we'll also be giving away our 2026 tax planning guide. And this is great because it has all the key numbers that you need with tax brackets, gifting amounts, just everything you really need to plan. If you call in to get a consultation, which is 1-800-994-8993. Again, that's 1-800-994-8993. Well, Jaclyn, when it comes to Uncle Sam, I realized that he basically really is a silent business partner, don't you think?
I don't know if I necessarily agree with that. Tell me a little bit more, Jenna.
Well, we do all the work. We take all the risks with these investments and manage the investments, watch the market, very diligently watching the investments like a hawk. And he still gets paid first without really even doing anything. That's kind of iconic behavior, right?
Yeah, exactly. So he's not, as much as he wants to be in the business, he is in the business. He just doesn't do his part. So I think there's a lot of
Exactly.
I in the team there.
Yes, it is. I like that. I and the team.
Yeah.
Yes, yes.
I
So
mean,
I
that's
tell you.
great. And Jenna, let's get started with this because it sounds like today we're going to be getting deeper into something that's kind of quietly impacting families more than almost anything else. And honestly, I think taxes are the number one thing that people forget about. And then
Yep.
it just Uncle Sam knocking at that door saying, "Where's my
Yep.
paycheck?"
Yep. Exactly.
So how, different investments grow from a tax perspective
Hmm.
and what happens when you take money out? Those are two different things. And so it's
Yes.
important to consult a CPA for tax advice. But Jenna, I appreciate that you're going to educate our listeners today from a financial advisor perspective and
Hmm.
about how the various investments are taxed, because I know that when putting together a financial plan, you say that it's important, super important to consider taxes because it's one of those things that will eat away at all the hard work that you've done. And taxes are truly one of the biggest expenses people will have throughout their lives.
Yes, it is definitely one of the biggest expenses that people have. And especially for some families, the difference between pre-tax return and after-tax return isn't small. It's actually material. So, Jaclyn, you can earn 8% on paper, but after Uncle Sam comes along and gets his cut, something very different is the net result of that. Once you take federal tax, state tax, once that enters the room, it's a very different picture. And trust me, he always enters the room.
He's always got a key to that door.
Uh-huh. Definitely.
Well, to kind of kick this off, let's break down by, account type and asset type. So, how the investments itself are taxed while they grow. So, Jenna, let's start with, taxable brokerage accounts. And
Mhm.
these, with the account that many families have in significant size.
Yep. Yep. Yeah. And so I want people to think about, these are the brokerage accounts that you have that are not in like an IRA, right? Just cash money you threw in from the bank to invest in the market. And taxable brokerage accounts, the growth is not shielded. There's three main tax events during the growth phase while you're just letting it sit there to grow. Qualified dividends are generally taxed at long-term capital gains rates. And non-qualified dividends are taxed as ordinary income. Bond interest, unless municipal, is taxed as ordinary income. For high earners, that can mean top federal taxes. And when you sell an appreciated investment, you trigger capital gains tax. Short-term gains taxed as ordinary income, long-term gains taxed at preferential capital gains rates. And for affluent investors, that often includes top capital gains bracket, 3.8% net investment income tax, state taxes layered on top of it.
You're absolutely right, Jenna. And so the IRS is basically a silent minority shareholder. So now we're talking about Uncle Sam being the I in the team. Yep, that's sure the case.
Yes. And he doesn't attend board meetings, but he definitely expects distributions, right?
Absolutely. Absolutely. Well,
Oh.
can you give us, maybe a strategic note for, the high net worth families here?
Yeah, well, especially with higher net worth families, tax efficiency inside brokerage accounts really matters deeply. Some people like to invest their, non-IRA money into index funds, which are pretty tax efficient. The actively managed funds can be somewhat tax efficient, especially if you harvest losses to offset gains. Which, Jaclyn, I don't know if you know this, but we have a portfolio called our Tax Advantage portfolio that automatically harvests losses to offset gains for our clients. And that is definitely important, especially with higher amounts of taxable brokerage accounts. And then municipal bonds are federally tax-free and sometimes state tax-free if issued in your state. Asset location becomes a sophisticated decision. It's not really just based on market risk. I mean, we do look at, what's your risk tolerance, but it's also really important to talk about tax efficiency. You've got to diversify not only from a market risk standpoint, but also from a tax efficiency standpoint, right?
Yeah, and that's a lot to keep track of. I mean, that's a lot of moving parts for sure, Jenna. So on
Yeah.
to, the second type of account, which is tax deferred accounts. So this would include your traditional IRA, your 401k, cash balance plans, etc. So why this is just let's contrast this, with the tax deferred accounts.
Yeah. Tax deferred accounts are really important because, especially in your higher earning years, they grow tax deferred. So it's powerful because the growth is not taxed annually if you're not taking it out. So no tax on dividends, no tax on interest, no capital gains. It compounds really uninterrupted. But this is critical. Eventually Uncle Sam comes knocking, right? And so once you start actually taking that money out, every dollar is taxed as ordinary income, not capital gains tax, not preferential rates, ordinary income tax rates. And so it's important to know that it feels good at the time when you're deferring it, but eventually you will pay the price when you're taking that money out because you're taxed at ordinary income rates.
Yeah, absolutely. So, your beautifully tax efficient stock fund loses its special status when it lives inside of a traditional IRA.
Correct. Inside a traditional IRA, everything eventually, like I said, becomes ordinary income. So it's kind of like a costume party where everybody gets dressed up as taxable, right?
I like that. And then for this type of account, how does this affect kind of the high net worth families?
Yeah, well, large balances can create a required minimum distribution, right? If we just keep letting those tax deferred IRAs grow or 401ks grow, eventually at 73 or 75, you're going to have a larger required minimum distribution to take out. You got to think about bracket compression in retirement. Medicare premiums can increase if you have over a certain amount of income, stacked income years. So deferral is powerful, but unmanaged deferral becomes a future tax concentration problem down the road in retirement, right?
Absolutely. And I'm glad that you pointed that out, Jenna. So now this is the one that I feel like is kind of a hot topic right now that seems to be talked about. And it's kind of the golden child, which
Oh,
is
yeah.
Roth accounts.
Yes. Roth accounts grow tax free. Now, I don't know about you, Jaclyn, but what do you prefer? Taxable money or tax-free money?
Well, I mean, I would say, Uncle Sam, get out of my business. So,
Yes, yes, we like tax-free, don't we?
yes.
Okay, yes. So we'll say that again. Roth IRAs have tax-free growth. So no tax on dividends, no tax on gains, no tax on withdrawals, as long as you wait until after 5 years to start withdrawing money out of the Roth IRA. And this is a big one. There's no required minimum distributions during the original owner's lifetime. So when you're 73 and 75, you don't have to take money out of a Roth IRA. You can just really let that continue to grow uninterrupted, right?
Yeah, absolutely. So Roth accounts remind me of me. I'm the golden child and the unicorn.
Yes, yes. They're pretty and they're just, all ready to roll, right?
Yes. Yes, absolutely.
So they're incredibly valuable, just like you, Jaclyn, for
Aw.
families that need, large retirement spending. I'm especially big on Roth IRAs for people that have it on their heart to leave a legacy to their family. Maybe they can just let the money grow for the rest of their life and pass it on. Because most of us, I'm sure, would rather leave tax-free money to our heirs. So Roth IRAs are really popular in legacy planning as well.
Yeah, and I just, I want to point out that it's also important to balance your accounts. Putting everything into a Roth is probably not the best solution for you.
Right.
And we'll probably get into that later in this episode, but it's just so important that, doing taxes now versus later, you want to balance that. And it seems like the
Yes.
unicorn, and it is, but it needs to be worked into a plan to be
Yep.
beneficial to you.
Exactly. And I love that you brought that up, Jaclyn, because we talk about how there's always market risk and you want to diversify your investments with market risk.
Mhm.
And that's often focused on pretty heavily. But you do want to diversify your portfolio from a tax standpoint as well. Like you said, you
Mhm.
don't want to have everything in Roth or everything in IRA or everything in real estate. But
Mhm.
having, different buckets of money that are taxed differently can also be very helpful as you're
Mhm.
planning, right?
Yeah, absolutely. Absolutely, Jenna. So now let's go on to the fourth type of account, which is real estate, houses and places that you own. So let's talk about that, Jenna.
Yeah, real estate can be a great investment to diversify. It has unique tax characteristics. Rental income is taxable, but
Mhm.
depreciation reduces taxable income. Expenses are deductible, so you may receive cash flow that exceeds taxable income, which feels slightly magical. When selling, though, the capital gains tax applies if you sell while you're alive. A lot of people ask me, well, Jen, I have this rental house. Should I sell it so it's easier for my kids and they won't have to manage it then when my health changes, that kind of thing? And I really tell them it kind of depends, because if you've got a lot of capital gain in that real estate, it might make more sense for them to just inherit that real estate, have somebody rent it or whatever while you're alive, because
Mhm.
then if you pass it on to them, they will get what's called a stepped up cost basis, which then really the capital gains tax would not apply if they sell it, pretty much right away. Another thing people do is something called a 1031 exchange. And of course, I'm not a real estate agent, but they basically just transfer, kind of reinvest into like kind property. And so that's another way to help with that capital gains tax.
Mhm.
So lots of options there.
Yeah. Well, and at the end of the day, real estate investors really don't like selling.
Yeah, they really don't. And so again, strategically positioning or letting the heirs inherit the real estate really can make a lot more sense if it's at all possible. Or sometimes people will transfer out of real estate and farmland and things like that into a charitable remainder trust, which is another tax planning strategy that we've done with some of our clients to help avoid paying that capital gains tax potentially. So there are some things you can do to manage that, but real estate, it is taxed as well, right, on the
Yeah.
gain.
Yeah, absolutely. Well, and so now let's move on to our fifth and final, account type, which is annuities.
Yes, yes, annuities. The growth is tax deferred, but when withdrawing, if it's a non-qualified, not an IRA annuity, the earnings are always going to come out first, and they are taxed at ordinary income, not capital gains tax. And sometimes that does surprise people.
Mm-hmm.
So it feels good with tax deferral, but you do have to remember that when you're taking the money out, it's going to be taxed on the at ordinary income tax rates.
Yeah, and I'm glad that you pointed that out, Jenna. And I just want to say that again, ordinary income.
Yes, exactly. Yep. And annuities can be appropriate for protection against market risk and longevity protection for financial peace of mind. But it is important to know how they're taxed as well. So,
Yeah, absolutely. Well, I'm glad that you brought all those up. And now that we know the difference and kind of, the game plan of all the different types of accounts, what really happens when you start withdrawing from these accounts? And this seems to be where the strategy matters most.
yes, yes. And that's where when we're doing an income plan, it is just so important for the financial advisor that you're working with to understand taxes. Because if you start withdrawing this money from the wrong buckets, man, it could really create a tax problem in retirement, bump you into a higher tax bracket, potentially even bump up your Medicare. So the
Mhm.
withdrawal matters so much. If you pull heavily from traditional IRAs or 401k accounts, it is going to increase your taxable income. If you pull out of the brokerage accounts, it triggers capital gains tax. Again, Roth, there's no tax impact as long as you have held the Roth for at least 5 years. So for many families, sequencing withdrawals will smooth out tax brackets across decades if you do it the right way. So it's not about avoiding taxes, but it is about managing timing, managing brackets, and managing control. It's so important. And I'll tell you, Jaclyn, I serve a couple right now that has well over 10 million in net worth. Brilliant investors, tremendous savers, but most of their wealth was in traditional IRA retirement accounts and highly appreciated stock. So when we got together and I looked at what they had, I said, you know, you really don't have as big of an investment problem as you do a tax problem. And
Mhm.
that surprised them. They hadn't really thought about the tax side of their investments. And the husband said, well, I always looked at the statement balance and assumed that this was ours. We're winning. We have a lot more than most people save. And that really is the human reaction. So we help them gradually harvest gains, working closely to kind of offset, losses or offset losses to harvest gains. And we worked closely with their CPA. The CPA helped do that. We helped with the CPA execute partial Roth conversions. We kind of layered withdrawals strategically, and we did increase the charitable gifting in high income years. So the result wasn't zero tax, but it was control and just having a plan, I think reduces anxiety, especially when you're dealing with, higher income levels, right?
Yeah, absolutely. Well, that's a great story. And I think, the big question here is what's the big message, Jenna? I mean, what is the overall overarching theme here for our listeners and viewers today?
Yeah, well, different investments grow differently tax wise. Like I said, non IRA, just taxable brokerage accounts, you need to know they're taxed at capital gains tax along the way. Traditional IRAs or 401ks grow tax deferred, but they're taxed later as ordinary income. Roth accounts are the golden child, like you, Jaclyn. Tax-free growth and tax-free withdrawals. I'll say that again. Tax-free growth, tax-free withdrawals, as long as held at least 5 years. Real estate, you've got depreciation benefits, capital gains at the sale if sold while you're alive. Annuities, tax-deferred growth, which can be so helpful in those higher income earning years. They are taxed at ordinary income on the gains upon withdrawal. And so really my big point to the investors that are listening today, instead of just looking at what's my return, you really want to look at what's my after-tax return. What's my lifetime income tax exposure? What does this look like over 30 years? Because it's really not how much you make, it's how much you actually get to keep, right?
Yeah.
At the end of the day, after Uncle Sam comes and takes his cut of it, right?
Yes, yes. And it's also important to note, a lot of these tax rules are for the, tax year. So,
Yep.
It's January 1st to December 31st. And so you really want to plan mostly for the year and talking with
Mhm.
your CPA, your financial advisor, using all of those resources together is what's going to
Mhm.
create the best plan for you so you can keep more money in your pockets.
Exactly. Yep. Absolutely. And, it's also very important, don't you think, Jaclyn, that whoever they work with does the holistic planning, because
Mhm.
again, you can run into a major tax problem, which you really don't want to do in retirement,
Mhm.
especially if you're not strategic and clever about, where you're taking withdrawals and what kind of investments you're investing in. You've got to consider taxes. And so
Yep.
many people do not consider the tax side of their investment plan. They just really focus on market risk, but you've got to have taxes looked at and work with an advisor that understands how investments are taxed, right?
Absolutely. Absolutely, Jenna. Well, as we close out today, what are your final thoughts?
Yeah, well, we would love for anyone that's listened today that says, maybe I've looked at my plan from an investment performance standpoint, a market risk standpoint, but I haven't really looked at it from the tax angle. And am I setting myself up for a major tax problem down the road with the way that my portfolio is set up? Or are my kids possibly going to have a major tax problem if I pass away? So if you'd like someone to give you a second opinion on your retirement plan and look at it from that tax angle, we would be honored to do that. And so you could give us a call to schedule a complimentary consultation at 1-800-994-8993. Again, that's 1-800-994-8993. And for anyone that calls in and schedules a consultation this month, you're also going to get the 2026 tax planning guide with all the key numbers you need to start doing your tax planning. What are the brackets? What are the required minimum distribution calculations? What's the gifting exclusion? All these numbers that you really need to plan for 2026. So you can give us a call and we would be happy to do the consultation, but also get you that 2026 tax planning guide.
Yeah. Well, thank you, Jenna. And that's a, great note there because I know that there's a lot of changes and we like to say that all these tax changes are written in pencil, so you never know when they're going to change. And,
Yeah.
it's so important that we differentiate the different accounts and what that means for you and your individual plan. So listeners and viewers, please, subscribe to us on YouTube so you can be notified as soon as our new episodes are out. We're also on Apple Podcasts, Spotify, and Amazon Music. And you can also check us out on the website. We're beaconwealthadvisory.com, and all of our past episodes are on there. So pick a topic that relates with you. All right, Jenna. Well, thank you for a great episode, and we'll see you guys next week.